Val Despard here with Beau Beery, all-star multifamily broker based in Gainesville, North Florida market. What would you say your market focus is? I know you're in like North Florida, right? Like all of North.
Yeah, I cover the northern half of Florida. So Polk County to the south is kind of my southern border. That's like Lakeland and Winter Haven. And then I skip over Orlando and Tampa because those are almost all institutional sales. Very, very few, in that 20 to 150 unit mark. And then I cover everything north. So Ocala, Gainesville, Tallahassee, Jacksonville, all down the coast, all of Volusia County, Daytona, New Smyrna, Ormond, and kind of everything in between. We're probably going to pick up the Pensacola area in 2025, and that'll be kind of rounding out the North Florida market. So yeah.
Nice, cool. Um, could you back up and talk about how you got into real estate initially and like what that looked like and kind of
Yeah.
what got you started?
Yeah, of course. When I was going to UF, I was actually a personal trainer for a couple of years, and that was going to be the route I went. I ended up not getting the job I wanted. I was bummed out. I walked into the gym, and a buddy of mine said, "Hey, man, well, you look bummed out. What's going on?" I'm like, I didn't get my job. He said, "Well, dude, I'm doing some leasing at a brand new apartment complex that's in the middle of construction right now. Like, we need help leasing apartments." I'm like, well, shoot, I don't have anything, like, I don't, I need something. I'm graduating. So yeah, that sounds good. That'll be a good in between. And I got in there, and within a few months, I was the top leasing guy. The property manager was really cool. Started showing me the books. And I started seeing, the income and the expenses, the net income, the unbelievable power of 800 tenants paying for a 444 unit community and never saw the owners. I was like, this is amazing. Like, how and so it just kind of like started clicking. And I was like, well, shoot, maybe I should get my real estate license. And I got my real estate license while still working there, just something to have. And when I was
Yeah.
getting my real estate license, everyone was talking about the master's degree in real estate program at UF, which is currently, I think, either at the top one or top three programs in the country. And it was top 10 back then. So I went and did my master's degree in real estate. It was a 10-month program, and then I bit the bug, man. The bug bit me, I guess, and
Yeah.
just started going crazy ever since.
Yeah, yeah. So how'd you get into sales, like specifically
Yeah.
selling?
So when I graduated with my master's degree, I had actually met my wife in college and then married her during the master's degree program. She's one of those people who very rare is born and raised in a town in Gainesville and wanted to stay there forever. And so I was obviously my possibilities were in my mind at the time limited. And so I just started interviewing all over the place. There was one of the top developers, not just in Gainesville, but in the region, AMJ Group, and they hired me on. I wanted to go into development, right? Like that's the big money. That's where everybody thinks is the big money. That's where,
Yeah,
especially a young guy at 20 something years old. I want to be
yeah,
a developer, right?
yeah,
And so he said, listen, he said, I'll teach you development, but I need help leasing my office spaces, my retail spaces. He had some industrial, and some apartments. And I was like, cool, man, like that sounds good. And in about 6 months, I got bit by the bug again. I'm like, man, I love this sales stuff. I mean, it's constant. And during that time, I'm starting to see like what it takes to be a developer. And that just was not my makeup. That was not my personality. It was way higher risk. I'm just not built that way, right? I saw for him, he killed it. He, dealt with like a champ. Like he was just built chemically to be able to do that kind of business. But I fell right into my own and did very well and worked for him for 10 years. Built a name for myself, brokering for one guy. An opportunity presented itself with a Coldwell Banker commercial to acquire the company with a couple partners, and went all in, went in multifamily brokerage. And year one, I was the top broker in the entire region. Year one, I did $26 million. Year two, I did $32 million. Year three, I did $48 million, and it just kept going up. And I was like, all
yeah.
right, this is the game.
You're like, this works. This is a
Yeah,
fit.
this works.
Yeah, yeah, yeah.
It's
Um,
awesome.
cool. So, can you go into kind of current day, your with your clients and your your work? What are you seeing in terms of supply demand, and what are the current dynamics
Yeah.
at play with your clients, and kind of what's trending right now?
Yeah, so I'll give you a quick history. Leading up to about mid 2022, which would be normal markets, right? Let's call it trailing 5 years from say 2018 to, mid 2022. In the northern half of Florida, there would typically be somewhere between 150 and 160 sales of apartment complexes over 10 units. Okay. So 12, 14 a month in the entire northern half of Florida, which many people are surprised to hear it's that few as it is, but it is. That's the market. And roughly 50% of those are over 100 units. The other 50% are under 100 units, right? In 2023, okay, there were only 21 sales over 100 units the entire year for the entire northern half of Florida. Okay. In 2024 year to date, we're at 11, right? So it'll probably end up matching 2023, but it is starting to trend up. The
Yeah.
big story here is under 100 unit sales. Okay. Under 100 unit sales are currently 73% of all sales. Even though under 100 units for number of complexes that exist are, I think it's 56%. Let me see here. Let's see here. Yeah, 36% of inventory is between 10 and 50 units, but that currently makes up 56% of sales. So almost all the sales are under between 10 and 50 units. Another 17% of sales are between 50 and 100. So if you combine the 56 and the 17, you got 73% of sales are now under 100 units when it's usually 50%. So that's the big uptick. Now, why is that the case? Well, as you know, from mid 2022 to now, interest rates went up quite a bit, right? They were up in the sevens. Now they're down in the high fives, which is great. But interest rates, and then in Florida, insurance went ape shit. Okay, I mean, it doubled, tripled, and oftentimes quadrupled. So you say, okay, well, Beau, well, still that would affect small properties. Yes, but everything's about proportion, right? So if you owned a $20 million apartment complex, the combination of interest rates going up and insurance going up, that costs a $20 million complex $4 or $5 million. Okay, so if you own that $20 million complex, and you could have sold it for $20 million, 2 years ago, and you don't have to sell today. You're not. You're just going to hold on to it, and you're going to wait for things to change, which is already happening, right?
Yeah.
Whereas the person who owns the $2 million 17-unit apartment complex in Daytona Beach, his value changed 100 grand, 150 grand, somewhere in there, maybe even 200 grand. But the people who own under 100 apartment complexes, their bases are very low because they hold them for much longer. The hold time is much longer. They bought them a long time ago. Their basis is much lower. They're not going to not sell over 150 grand, right? They probably only own that one complex, maybe 2 or 3 complexes. They've had them for 8, 10, 30 years in a lot of cases. And so they've added the value they've wanted to. They don't really pay attention too much to what's going on in the global markets, as long as it's not pandemonium and values have dipped down tremendously. They're selling. Now, it's still selling way more number of complexes than the trailing 5 years from 2022, but they're still trading at a much higher clip than 100 plus units. Now, things are starting to change, right? The 100 plus units, I'm doing way more BOVs. The sales have picked up. Okay, there was only 7 sales up until about a month ago. We just added another 4 just in the last month, right? Month and a half. So those are starting to trend up. The BOVs are up. Pricing is actually for under 100 units is up, I think, 3.2% from the same period in 2023. For 100 plus units, they are down. The pricing is down even from a year ago, and of course is down. It was down as high as 18% last year. So call it mid 2023 comparing to mid 2022, it was between 15 and 20% decline in value for 100 plus units. A lot of that is eroded away. Okay, I haven't done the most recent sales because there's only been 11, and that's not enough statistical probability to to actually have weight in what I would say. I'm waiting till the end of the year to see how much it's dipped, but I know that 15 to 20% has been cut at least in half. Okay, especially as interest rates change. And next month we should get a quarter to a half point relief again with the Fed's meeting in mid-September.
Yeah. What are you seeing in terms of cap rates? I'm sure it's all over. It depends on location, and asset quality. But what are you seeing in terms of cap rates now
Yeah,
with the debt in fives?
let me talk more. Let me tell you the metrics I follow, just because I know people like to use cap rates because there's really another way to talk about returns on properties without using a bunch of asterisks, right? So like, to give you, for instance, when an appraiser calls me, they're like, "Hey, Beau, I saw that you sold XYZ apartments. Hey, was that an arm's length transaction? What was the cap rate?" Right?
Yeah.
And I hate the question because it doesn't mean anything, right? Unless you ask, okay, thanks for that cap rate. So what did you use for vacancy rate? Did you reset the property taxes? Does that include a new insurance quote? Does that include management fee in there? Right? So like, there's so many other questions you have to ask in order to, like, apples to apples compare the cap rate this random broker just told you on the phone to the other random broker or seller you just talked to over there. If you don't ask the other 10 questions, they don't mean shit, right? So I can tell you a cap rate, Val, but it's like, unless someone else did it exactly like I did, it could swing between a quarter and a point and a quarter, right? That's why I pay attention to cash on cash return, IRR, equity multiple, debt coverage ratios, and debt yields, right? So what I'm seeing is, by the end of year one or in year two, most investors want to earn at least a 7% cash on cash return. Some of the bigger players and institutional guys will go down to 6. They want to have at least a 15% IRR on a 5-year hold minimum. Big boys will go down to 12-ish, okay? That they can get cheaper debt. They want to at least double their equity, so a 2.0 equity multiple on a 5-year hold. Big boys will go down a little bit less. Of course, debt coverage ratios need to be, for most folks, somewhere between 1.25 and 1.35, and debt yields 8 to 9% plus. Now, the debt coverage ratios and the debt yields aren't really a factor right now, right? Because your loan to values, what used to be 80% loan to values, are now between 65 and 70, 75%. So most of your hurdles on those two aren't much of a big deal. So I tell you all this, Val, because when I'm underwriting something, I'm underwriting to a combination of those 5 factors. Cap rates have absolutely nothing to do with my valuations. They don't have anything to do with most brokers' valuations. We are plugging in all the incomes and expenses and renovation budget into a model, and then we keep playing with the price until we have a satisfactory balance of that cash on cash, the debt coverage ratio, the debt yield, the IRR, and the equity multiple, right? What I'm seeing as a result of those are most cap rates, if I just use a cumulative average of every deal I've done from a C class asset to an A class asset, most of the time the resulting cap rate as a result of that pricing is between 6.25 and 6.75, right?
Yeah.
Now, once you get B plus class assets, you can be anywhere from 5.5 to 6%, right? 5.5s would be like primo, right? Because that's still negative leverage. Right? You still have negative leverage when you're in the 5s, but because rents are still doing pretty decent, usually by year 2, you're now starting to have some positive leverage. By year 3, it's starting to get better and better, and so forth. C class assets are probably 3/4 up to about 7.5 as a resulting cap rate. Now, keep in mind that my cap rates are, I'm you're inputting a certain capex budget, and you have a certain an increase in rent yield that you're inputting there, and how much are your expenses growing at. So there's a lot of moving parts. That's why even when I'm reporting my sales on my website of everything that's ever sold, cap rates aren't even on there, because it's too misleading. I don't want
That's
some
great.
person to read. I don't want someone to read on there a 6.5 cap on something, and then they end up not calling me, and theirs could have been a 5.9, right? It just doesn't. You just don't know.
Yeah, yeah, that's good. Man, that could be a seminar or class. We could just take that last 5 minutes and start teaching, students. That's great. So how can people get a hold of you? Anybody in the
Yeah,
multifamily game, North Florida?
yeah. Thanks for
What's the best
asking.
way to reach you?
Three ways. My website is beaubeery.com, BeauBeery. On there, obviously, is my contact information. But one of the things you want to look at there, whether you're buying in North Florida or not, you want to try to master the kind of stats that I have on my website for your markets. So even on the landing page, if you scroll down, you can see all the kind of things I trade. If you click on resources at the top, you'll see all the markets I cover. Click on any one of those markets and see the kind of stats I'm tracking as a broker. And if you can master those stats as an investor or broker in your markets, you can react to opportunities very quickly. Second way is I have a YouTube channel called Beau Knows Multifamily. I've got playlists for beginners, advanced level investors. I have analytical playlists. And then the third way is I wrote a very popular book called Multifamily Investors Who Dominate. It's in hardcover, soft cover, Audible, Kindle, but that is an inside look at the types of conversations between listing brokers and sellers, how we choose buyers, how buyers can become a magnet for every listing that comes to market, and even before market.
Yeah, that's great. Good stuff. Appreciate your time.
Yeah, of
That was
course, man.
awesome. Yeah, talk soon.
All right, brother. Thanks for having me on. See ya.
Not at all.